Next stock we're going to do, Paul, is Dollar Tree.
Oh.
Good old Dollar Tree. The ticker symbol is DLTR. DLTR. And we're going to take this one nice and slow because everyone knows about this. Formerly known as Only a Dollar, it's an American chain of discount variety stores that sells items for $1 or less. Headquartered in Chesapeake, Virginia. It's a Fortune 500 company and operates, 15,000 stores in the U.S. and Canada. This is
and
huge.
By the way,
Dollar Tree.
That's another thing coming very soon to the software, company descriptions. That's coming to the software this month. They'll be at the bottom of every page, of every main page. Look at this chart from 1996, Seth.
Back in the day, you and I were freshmen.
$1 when we were freshmen in high school. Literally, no, 1985. We were 8th grade. $1.16, $1.17. Now it's at $100. Amazing growth. Okay, guys, $23 billion company, 16 PE, check mark. Understandable profit margin, it's an X, but they have good gross margin of 31%, but a bad profit margin of 5.7. No dividend, and not so great return on assets and return on invested capital, but that's all right. Income.
Profit growth, revenue growth over the past 5 years, Paul.
20.92, 25.7, check mark. Guys, with 15,000 locations, I want to know how much they're growing and to see how much is from there. So 15,000 locations, guys. We have $25.7 billion in revenue. They do an average of $1.7 million per location per year.
Is that a lot or a little?
I mean, that seems like a lot. Doesn't it?
Yeah, is this good growth or slow growth for a company of this magnitude?
Oh, I think this is good growth. That's why I wonder how much of it's from new locations. Because I'm surprised to see that. With such a big company, you'd expect it to grow with about the economy size. And when times are good, a store like Dollar Tree is not going to do as well because people can afford to go spend more money and not look for deals. When times are bad, they're going to do even better. All right? Net income.
Profit growth over the past 5 years, pillar number 4.
864 to 1.47. Check mark there. All right?
Very good.
There's one big drop here. I guarantee that big write-off. There it is. Big write-off of $2.7 billion. It tells a story, guys. All these things we teach you are telling you a story.
Oh, Dollar Tree bought Family Dollar, by the way, Ian saying. I didn't know that.
When? What year?
No, tell us. Somebody look it up. Let's go to shares outstanding is pillar number 5.
236 down to 233. Check mark there.
Check, please.
Okay.
So they are slightly buying shares back. Balance sheet. I imagine this is going to be negative. 5.3 billion to 3.9. Check mark there. Good.
2015 is when they bought out Family Dollar.
Okay. Cash flow statement. You ready?
This is free cash flow?
Yep.
Here we go.
1.29 to 1.43 check mark with an average of 1.12 times 20 equals 22.4 billion. Is that it is?
Actual market cap is 23 billion.
So it's about there if you're willing to pay 20 times free cash flow. I don't know. Let's put it in our, why don't we have Mo go over there and do that? So wait a second, really quick. Actually, time out. Here are the 8 pillars, guys. This is barely an X, but it's an X nonetheless. We have checks all the way around with profit margin being understandable for being low.
Mo, are people... How
You
does
mean, Paul, will you stop talking? Is that what you're asking?
Yeah, sure. How does Dollar... Oh, this is Dollar Tree you're pulling up right here?
Yep.
Oh, Lord.
So this is a great example of every time you get a gap, it fills. See, it filled. Every time you get a gap here, it filled. Every time you get a gap right here, it came back down and it filled. So I pull this up and I say this because I always say the gaps fill. Here's a prime example of that. Now, they just recently gapped again. So last week, there was a gap down. So I assume that that thing is going to fill eventually. So this might be one that you want to throw on the watch list. Earnings are not for a long time, so we don't have to worry about any gaps. Hopefully this thing turns and turns up into the sweet spot, fills that gap, and we can make some money coming up to this 117, 115 area. So there's another one. Throw it on the watch list. This is something to watch. But this is a great lesson of gaps always fill. I don't know how long it takes, but they're going to fill. You can see that right here.
So, another learning lesson here, guys.
Go ahead.
I'm looking at this. I put my data in 10%, and it says $50 on the high side. I go, what? It's only a 16, 17, 18 PE. What's going on? Then, I look at the story. 5-year average profit margin, 2.8%. Last year, 5.3%. Remember, there was a big write-off in the 1 year for $2.7 billion. So I immediately discard this 2.8%. I'm going to change this to 5%. And look what it changes the price to immediately. Boom. This is the price, 63 to 91, assuming a 10% return and 15 times PE. So it's probably worth somewhere in the 70 to 80 hour range for a reasonable assumption for price. Maybe a little bit higher because as the economy slows, we're in a booming economy, it might make more money, it might grow better. So maybe right now is a reasonable price for the stock. I don't know. The point is, we're not that far off with Dollar Tree. We're not that far off. And this is why you have to pay attention to this data, because you look at this and you thought to yourself, oh my God, it's 2.8%. That's why in our software, you're going to enter the profit margin yourself. It's going to tell you the last 5 years, the last 10 years, and the last year. You enter your own assumption. Because this immediately, I was like, wait a second, how is the profit margin so low? This is an example of me discarding this profit margin because they had a $2.7 billion write-off. Now, you need to go understand what that write-off was for. Go figure out what that write-off was for and make sure it's not a recurring problem they have internally. This is awesome. These are the things I love doing when I see like issues to teach with.
Paul, I want to take a short memoir out of my mind at the moment. Folks, I went almost 12 years investing in stocks, and all I ever looked at was the ticker. I would buy it and then just hope it went up, right? If you're like me, I'm just astounded to see these two guys in front of me and teach me. Paul, I've said, regardless of 500-600 people watching, I feel like you're just talking to me when I'm paying attention. But the amount of thought that goes into some of these companies is astounding. These graphs, these charts, it almost, when I hear people, when I hear normal people talk about buying stocks or day trading, I literally just start chuckling inside, knowing they're probably not doing all this stuff. And it's just really insightful to see in person. And I hope you're getting this too if you're watching at home. So,
and we got a great question here. Somebody said, how important is profit margin? I'm eliminating that pillar. It's the least important pillar out of all of them. The reason the profit margin came up is I prefer businesses with higher margins. There's more latitude. Higher margins with a lot of barrier to entry is a phenomenal business. Something like Microsoft. Very, very high margins. And how do you take over Microsoft? How do you get the world off of Microsoft Office, Microsoft Windows, all that stuff? It'd be very, very difficult. They have a very high moat in that regard. So I do ignore profit margin the most. I just like to know it from the standpoint of just having an understanding for it. I look at gross margin a lot, things like that.
Mo, the offer still stands, Mo, to join the Bid and Ask on a trial month. Is that true?
You get 30 days to come into the Bid and Ask Nation and try it out. If you do not like it, which you will like it, but you can go back to whatever price you're paying. So if you're paying $23, you go back to $23. If you're paying $8, you go back to $8. 30-day trial. Try it in the Bid and Ask Nation, and we are reorganizing that thing. I'm working with Tim right now, and it's getting a lot better, a lot more streamlined.